Okay, let's unpack this. Ever get that feeling your financial IQ just like tanked? Watching some TikTok guru promise you can turn your rent money into a private island by next Tuesday.
Oh, yeah. Or maybe you remember the GameStop saga back in, what, early 2021?
Exactly. That was wild. The stock went from like $15 to 500.
500 before crashing right back down.
Total market mayhem. It really makes you wonder if anyone actually knows what's going on sometimes.
Well, what's fascinating, and I think often gets overlooked in all that drama, are the fundamental principles, the things that can actually help you build wealth long term.
Yeah, without needing a crystal ball or getting lucky on a meme stock.
Precisely.
Exactly. So welcome to the deep dive. We're going to skip the get-rich-quick stuff today.
Uh-huh.
We're digging into some real time-tested financial wisdom. It comes from Burton Malkiel's classic book, A Random Walk Down Wall Street.
Right. Think of this as getting the essentials from decades of smart investing thinking, but geared for you, the listener.
Exactly. And Malkiel's book, it's been around for 50 years, right?
Yeah.
Still going strong.
It is. And the core message is surprisingly straightforward, but honestly incredibly powerful for your actual financial future.
Straightforward is right. Malkiel basically argues that, trying to outsmart the market, picking individual stocks, timing your buys and sells perfectly
Yeah.
is mostly a waste of time. He famously said even a, quote, blindfolded chimpanzee throwing darts at the stock pages could probably do about as well as the experts.
Wow. Pretty bold statement, isn't it?
It is.
And it really raises a crucial question for anyone listening. If beating the market is that hard, consistently anyway, what should you be doing with your money? How do you reach your goals?
And that's exactly what we're here to figure out today. We're not just going to rehash academic theories.
No.
We're extracting the practical stuff, the real-life takeaways from this really influential book. What can you actually do, maybe starting today, to make smarter investment decisions?
And, just as importantly, how can you sidestep those common mistakes? The ones that trip up so many investors.
Right. So where do we start?
Well, let's dive into a really foundational concept. It underpins pretty much all of Malkiel's thinking. The idea of market efficiency.
Okay, market efficiency. Break that down for us. What does that actually mean, in this context?
Okay, so the core idea, it's called the efficient market hypothesis, or EMH for short. It suggests that current stock prices already reflect all the publicly available information out there, and they reflect it remarkably quickly.
So like that hot stock tip you hear about from your cousin.
Yeah, exactly. By the time it gets to you, the market's probably already processed that info. It's baked into the price already.
Huh. So it's not like there's some secret Wall Street cheat code that only the insiders know.
Well, in a relatively efficient market, which is how Malkiel describes it, trying to consistently find those hidden gems, those undervalued stocks, or predict the market swings, it becomes an incredibly tough uphill battle.
Relative efficiency. So not perfectly efficient, but efficient enough.
Efficient enough that consistently beating it, especially after you factor in costs like fees and taxes, is a huge challenge for pretty much everyone. The key insight for you, the listener, is that you're unlikely to possess information that isn't already reflected in the stock price.
Okay, that makes sense. So if trying to beat the market is, well, probably not going to work consistently, what's the practical alternative for us regular folks?
Right, and this is where index funds really come into their own. Malkiel is a huge advocate for a strategy of just buying and holding broad-based index funds.
Index funds. So those are the ones that just track a whole market index, like the S&P 500.
Exactly. The S&P 500 is a common one representing large U.S. companies. But ideally, you might even want something broader, like, say, the Russell 3000 or the Wilshire Total Market Index.
So you get exposure to an even wider slice of the market.
Precisely. So instead of trying to pick the needle out of the haystack, the next big winner, you're essentially buying a tiny piece of, well, almost all the publicly traded companies.
Okay.
You capture the market's overall return, more or less, without the higher costs and, frankly, the added risks of trying to pick individual stocks yourself.
Right.
And what's really fascinating is when Malkiel first wrote the book, index funds weren't really a thing for the average person.
No way. Really?
Yeah. Their explosion in popularity since then has really just strongly supported his whole argument.
That kind of blows my mind. So how did these index funds stack up against, say, the actively managed funds, the ones you often hear about from brokers?
Good question. So active funds, they employ professional managers, right? People whose job it is to try and outperform the market by picking stocks they think will do better than average.
Okay.
But these managers, they charge higher fees, often around, say, 1% per year, sometimes more. That covers their research, their trading,
Uh-huh.
and they tend to trade more often, which means higher turnover in the fund. That can lead to higher trading costs and potentially more taxes for you, the investor.
And those costs really add up over time, don't they?
They really do. That 1% might not sound like a lot year to year,
Yeah, seems small.
but think about it compounded over decades. If the market gives you, say, 7% on average, and your active fund takes 1% in fees, you're only getting 6%. That difference can be massive by the time you retire.
Wow.
Malkiel uses this great analogy from Garrison Keillor's Lake Wobegon, where all the children are above average.
Oh, yeah.
Well, statistically, it's impossible for all active managers as a group to be above average after you subtract their costs. The math just doesn't work.
That analogy really hits home. Okay, so a key actionable insight here for everyone listening. Seriously, consider making low-cost, broad-based index funds or ETFs, exchange-traded funds, which are similar.
Right, they trade like stocks.
Make those the cornerstone, the core of your investment portfolio.
Absolutely, and building on that idea that beating the market is tough.
Yeah.
Let's talk about another big mistake investors make, trying to time the market.
Ah, yes. The old buy low, sell high. Sounds so simple, doesn't it?
Deceptively simple, but notoriously difficult to actually do in practice. Malkiel shows a lot of evidence that investors, both individuals and even institutions, they tend to do the exact opposite. They get swept up in the optimism when things are booming and buy high.
FOMO kicks in.
Exactly. Fear of missing out. And then when the market drops and pessimism is rampant, they panic and sell low. It's emotional investing, really.
I can definitely relate to that temptation, though. When everyone's talking about making money,
Yeah.
it's hard not to want to jump on board.
Oh, for sure. And history is just littered with examples of market bubbles fueled by that kind of irrational exuberance.
Like,
Well, you go way back, you have the Dutch tulip bulb craze. More recently, the dot-com bubble around 2000.
oh, yeah.
The U.S. housing bubble before 2008, and even the booms and busts we've seen in things like cryptocurrencies and NFTs.
Right.
And even those really extreme cases, trying to pinpoint the exact top and get out at just the right moment, almost impossible.
I remember the globe.com. Wasn't that one of the big .com flameouts? IPO'd like $9, shot up to nearly $100 in one day.
That's the one. And then poof.
Yeah.
Didn't stick around.
It's a pretty stark reminder of how fast things can turn and how futile it is trying to time those massive swings perfectly.
And what's really interesting is even after these huge crashes, there are rarely clear signals beforehand that everyone can reliably use to get out profitably. Malkiel points out even sophisticated hedge funds betting against GameStop when its price was going nuts, they faced massive losses.
Wow. Okay.
So the actionable insight here really is avoid trying to time the market. Just don't do it.
Okay. So what instead?
Focus on a long-term plan. Invest consistently over time, no matter what the market's doing day to day. That approach is often called dollar cost averaging. You invest a fixed amount at regular intervals.
Got it. Steady contributions over the long haul. Okay. So we've established the market's pretty smart, probably smarter than us individually.
Generally, yes.
And trying to outguess it, timing it, usually a losing game. Now let's talk about something maybe a bit more personal. The weird ways our own brains can mess up our investment decisions.
Ah, yes. This brings us into the really fascinating field of behavioral finance.
Yeah.
Malkiel does a great job highlighting how these psychological biases we all have can lead us to make totally irrational investment choices. Choices that ultimately hurt our long-term goals.
So our own psychology is the enemy.
It can be. Our brains, they're amazing, but they didn't exactly evolve to deal with complex financial markets, and that mismatch leads to some pretty predictable errors.
Okay, give us some examples. What kind of biases are we talking about?
Well, a really common one is just plain overconfidence. We tend to overestimate our own knowledge, our own abilities. Maybe we think we can spot trends that aren't really there, or we have some special insight into which stocks are going to take off.
Right.
But as Malkiel hammers home, stock price movements are remarkably random, close to what mathematicians call a random walk.
So that hot tip from my brother-in-law who knows a guy, probably not a reliable edge.
Statistically, the odds are very much against it being useful information that isn't already out there and priced in.
Okay, what else?
Then there are things like bias judgments, we might judge how likely something is based on how similar it seems to something we already know, even if that similarity doesn't actually make it more probable. Malkiel mentions the classic Linda experiment from psychology here.
Interesting. And what about herd behavior? I feel like everyone's experienced that.
Oh, absolutely. That fear of missing out, FOMO, kicks in hard.
Yeah.
Suddenly, everyone's piling into the same trendy stock or asset, whether there's a good fundamental reason or not. We saw that massively during the dot-com bubble.
Definitely.
And it's not just individual investors. Even professional mutual fund managers often tend to, well, herd together, investing in the same popular stocks.
Really? Even the pros?
Yeah. And there's research like from Delbar Associates suggesting the average investor actually underperforms the market by something like 5 percentage points a year.
5%. That's huge.
It is. And the big reason for that gap is poor timing decisions, often driven by following the herd or reacting emotionally to market swings. You're potentially leaving a lot of money on the table just by letting emotions or the crowd dictate your moves.
Wow. 5 points a year.
Yeah.
That really drives home the cost of emotional investing. What other biases should we watch out for?
Another really powerful one is loss aversion.
Loss aversion.
Yeah. The psychological pain we feel from losing money is way greater than the pleasure we get from an equivalent gain. Studies show it might take like a $250 gain to make up for the psychological sting of losing just $100.
I believe that.
And this bias can lead to bad decisions, like selling your winning stocks too early just to lock in that good feeling, while stubbornly holding on to your losers for way too long, just hoping they'll eventually break even.
Oh man, I know I've been guilty of that one. It's hard to admit you made a mistake and just sell something that's down.
It really is. And related to that are feelings of pride and regret. They can mess with your selling decisions too. Holding on to winners too long out of pride, or avoiding selling losers because you don't want to face the regret. It stops being about sound financial reasoning.
Okay, so our brains are kind of working against us here.
Yeah.
What does Malkiel say we should do? What are his specific stupid investor tricks to avoid?
He lays out a few key ones.
Okay, lay them on us.
Yeah.
We need this.
All right. First, and this goes back to the herd behavior thing, steer clear of any investment that suddenly becomes the hot topic everyone's hyping up.
Right.
History shows when everyone is talking about something as a sure bet, whether it was gold in the early 80s or Japanese real estate later that decade or internet stocks in the late 90s, it's often a sign that the easy money's been made. The risk of a big downturn is probably increasing.
Makes sense. If everyone's already bought in, who's left to push the price higher?
Exactly. Second big one, resist the urge to overtrade.
Okay, less is more.
Pretty much. Constantly buying and selling just racks up transaction costs, broker fees, and potentially taxes. And it generally doesn't improve your returns. Warren Buffett has that great quote.
Yeah.
Something like, lethargy bordering on sloth remains the cornerstone of our investment style.
I love that. So being a bit lazy with your portfolio can actually be good.
It often is. Third point. If you do trade individual stocks, Malkiel gives some counterintuitive advice, especially regarding loss aversion. He says, sell your losers, hold on to your winners.
Sell the losers.
Yeah.
Even though it hurts.
Yeah. It helps you avoid that trap of clinging to underperformers. Plus, it can have tax benefits, something called tax loss harvesting.
Oh, okay. Good tip, especially around tax time.
Yeah.
And the final stupid trick to avoid.
Stay away from hot IPOs, initial public offerings.
Why is that? Aren't those supposed to be exciting?
Well, the thing is, as an individual investor, you rarely get access to the really good, promising IPOs at the initial low price. By the time your broker might be pushing shares of a new company on you, it often means the big institutional players have already passed on it. It might not be such a great deal for you.
Gotcha. So the big takeaway from all this behavioral stuff is we need to be aware of our own psychological traps.
Exactly. Cultivate that self-awareness and actively work to avoid these common mistakes. Resist chasing hype. Don't trade constantly just for the sake of it, and let your long-term plan, not your gut feelings or emotions, drive your decisions.
Okay, good advice. Now, let's shift gears slightly. Can we briefly touch on the main ways people try to pick stocks? You hear about fundamental and technical analysis all the time.
Sure, these are the two main schools of thought, generally speaking.
Right. What's the core difference? What are they actually doing?
Okay, so technical analysis, sometimes called chartism, is all about looking at past market data, mostly price movements and trading volume.
Looking at charts.
Exactly. They look for patterns, like head and shoulders formations, or identify support and resistance levels on the chart. The idea is that these past patterns can help predict future price movements. They tend to believe market psychology drives prices more than company fundamentals, at least in the short term.
Does it work?
Well, according to Malkiel and tons of academic research, not really. Extensive testing consistently shows that past stock price movements aren't reliable predictors of future ones.
So the market doesn't really remember.
As Malkiel puts it, the market has little, if any, memory. It's very close to that random walk idea we mentioned.
Okay, so trying to predict the future by looking at squiggly lines on a chart is probably not the best use of time.
That seems to be the conclusion, yes. It's more like trying to read tea leaves, perhaps.
Got it. What about the other approach? Fundamental analysis.
Right. Fundamental analysis is completely different. It tries to figure out a stock's true or intrinsic value by digging into the underlying company. By analyzing its financial health, things like revenue, earnings, profits, debt levels, also looking at the quality of management, the company's competitive position, future growth prospects, the overall economic outlook.
So really getting into the nuts and bolts of the business itself.
Exactly. They try to estimate future cash flows, figure out what the company is really worth based on its fundamentals. They might use things like the Rule of 72 to understand compounding growth.
Okay, that sounds much more rigorous. Does that work?
Well, it's certainly more grounded in reality, but even fundamental analysis has big challenges.
Like what?
For one, the information you're using might be incomplete or just plain wrong. Your assumptions about the future earnings, future growth could easily be off.
Right. Predicting the future is hard.
Very.
Yeah.
And even if you do calculate a true value, there's no guarantee the market price will actually reach that value anytime soon, or ever. The market can stay irrational longer than you can stay solvent, as the saying goes.
So even doing all that homework doesn't guarantee you'll beat the market either.
Malkiel's conclusion, basically, is that while fundamental analysis is useful for understanding businesses, consistently using it to outperform the market is still extremely difficult, especially for individual investors who just don't have the resources, the time, the real-time data access that big professional firms do.
Interesting.
And he notes that even Benjamin Graham, who's like the father of fundamental analysis.
Yeah, the value investing guy.
Right. Even he came to believe later in life that for most investors, it probably wasn't a reliable way to get superior returns anymore because the market had become more efficient.
Wow. So the actionable insight here is understand the basics of both approaches, technical and fundamental.
Yeah, know what they are.
But be pretty skeptical about your ability as an individual to use them to consistently beat the market.
Exactly. Your time and energy are likely better spent focusing on those broader market trends and, crucially, on diversification.
Okay, diversification. We've touched on it,
Yes.
but let's talk about risk. That's obviously huge in investing.
Absolutely fundamental. In investing, risk and potential reward are basically two sides of the same coin. Generally speaking, if you want the chance for higher returns, you have to accept a greater degree of risk.
Makes sense.
Now, diversification is your number one tool for managing a specific type of risk called unsystematic risk.
Unsystematic risk.
Yeah, that's the risk tied to a specific company or a specific industry doing poorly. Like if you put all your money in one tech stock and that company hits trouble, you could lose big.
Ah, the classic, don't put all your eggs in one basket advice.
That's exactly it. By spreading your investments across many different things, different stocks in different sectors, bonds, maybe international stocks, maybe even real estate, you reduce the chance that a disaster in one area will sink your whole portfolio. If one stock tanks, the others might be doing okay or even well.
So it smooths out the bumps.
Precisely. Malkiel mentions that owning maybe 20 to 30 well-chosen different stocks can significantly cut down that company's specific risk. Get up to around 50 and you've nearly eliminated it.
Wow.
And for global diversification, aiming for a similar number of international stocks is also a good idea. It just reduces the overall volatility, the ups and downs of your portfolio.
Got it. Is all risk diversifiable?
No, there's also systematic risk or market risk. That's the risk that affects the entire market, things like recessions, interest rate changes, geopolitical events. You can't diversify that away completely.
Sorry.
Modern portfolio theory gets deep into this stuff, using concepts like beta to measure how sensitive a stock is to overall market movements. But honestly, for most people, Malkiel's core advice holds. Broad diversification through low-cost index funds is a super practical way to manage the risk you can control without getting lost in complex theories.
Okay. So takeaway, diversify, diversify, diversify. Spread your investments out across different asset types, industries, and even countries to lower your overall risk.
That's a huge part of the strategy.
All right, we've covered a ton of ground market efficiency, timing pitfalls, our own psychology, analysis methods, risk. Let's try and bring it all together now. What are the practical steps? What can you listening right now actually do based on Malkiel's advice,
Yeah.
especially if you're a do-it-yourself kind of investor?
Okay, the bottom line recommendation from a random walk down Wall Street, especially for your serious money like retirement savings.
Yeah. The important stuff.
Build the core of your portfolio with a diversified mix of low-cost index funds. That's your foundation. Simple, broad, low cost.
Keep it simple, keep it broad, keep costs down. That really does seem like the recurring theme here. Makes a lot of sense.
It does.
But what if someone still has that itch? You know, they hear about stocks, they want to try picking a few winners, maybe with just a small part of their money, their fun money.
Yeah, Malkiel acknowledges that some people just enjoy that challenge, even knowing the odds are tough.
Right.
So if you are going to allocate a small slice, maybe 5 or 10% of your capital, to picking individual stocks, he suggests following some sensible rules. But always remember, consistently beating the market this way is a real long shot.
Okay, what are those rules for the more adventurous investor playing with fun money?
Rule 1. Focus on companies that look like they can sustain above-average earnings growth for at least 5 years out. Look for quality growth.
Okay.
Rule 2. Never pay more for a stock than its firm foundation of value. Basically, don't overpay. You can use the overall market's price-to-earnings PE ratio as a rough guide. Don't pay wildly more than the average.
Got it. Don't chase hype valuation.
Right. Rule 3. Look for sleepers. Companies or situations with good growth prospects that the wider market hasn't fully noticed or appreciated yet.
The hidden gems. Hard to find, I imagine.
Very hard. And Rule 4, which echoes our earlier point, trade as little as possible.
Back to the lethargy.
Back to lethargy. You know, the old advice is ride your winners, sell your losers, but always keep taxes in mind. And Malkiel emphasizes being merciless with the losers to capture those potential tax benefits we talked about.
Okay, so disciplined rules, even for the fun money. What about people who hear all this and think, wow, I just want someone else to handle it? The completely hands-off approach.
Yeah, for folks who prefer a more automated solution, things like low-cost robo-advisors are a really good option these days.
Robo-advisors.
Yeah, these are online platforms. You tell them your goals, your risk tolerance, and they create and manage a diversified portfolio for you, usually using low-cost index funds or ETFs. And their advisory fees are typically very low compared to traditional human advisors.
Interesting. So whether you DIY or you want it automated, the core principles, diversification, low cost, long-term focus, they still apply.
Exactly. The fundamental ideas are the same. So the key actionable insight is really prioritize that core portfolio. Make it broadly diversified, low-cost index funds for your big long-term goals. If you want to dabble in stock picking, okay, but keep it small, understand the risks, follow disciplined rules, and know it's tough to win consistently.
All right, so let's wrap up this deep dive into a random walk down Wall Street. If listeners take away just a few key things, what should they be?
Okay, number 1. Financial markets are pretty efficient. It's really, really hard to consistently beat the market average, especially after costs.
Got it.
Number 2, because of that, investing in low-cost, broadly diversified index funds is often a superior strategy for most people. It's effective and less stressful.
Makes sense.
Number 3, don't try to time the market. Forget predicting peaks and troughs. Focus on investing for the long term and making consistent contributions.
Dollar cost averaging.
Exactly. Number 4, be aware of your own behavioral biases. Work actively to avoid those common mistakes like following the herd, overtrading, or letting fear and greed drive your decisions.
Know thyself, investor.
Pretty much. And finally, number 5, diversification is absolutely crucial. Spread your investments across different asset classes, sectors, maybe even countries to manage your risk effectively.
Wow. Okay, so even after 50 years, these core ideas from a random walk down Wall Street feel incredibly relevant. They provide a really solid, actionable framework for, well, for your investment journey, for anyone listening.
Absolutely. And maybe it leaves us with a final thought, something for you to chew on.
Ooh, a provocative thought.
Yeah, kinda. If everyone, or at least a huge majority of investors, really bought into market efficiency and just put all their money into index funds, would that very behavior create new inefficiencies?
Huh. Like if no one's doing the hard work of fundamental analysis, maybe bargains would appear.
Exactly. Would it open the door for skilled or lucky stock pickers again? Or are there always going to be some pockets of inefficiency out there, even if they're incredibly hard to find and exploit consistently?
That's a really interesting question.
Yeah.
Makes you think.
It does. So we encourage everyone listening to reflect on their own investment philosophy. How do these principles we've talked about today fit with your goals, your temperament? How might they shape your approach to building wealth over the long term? There's always more to learn, both about the markets and about ourselves.